Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Tuesday, December the 2nd, 2025. Not a huge amount of data today. What data we did get, some of it's a little bit sort of lagging, so to speak, going back to September. But we got relatively weak ISM manufacturing. Of course, we're going to get the services later this week. But as you can see here, the headline number is in contraction territory, so 48.2, which is a little bit below estimate and definitely below 50. One of the issues here as well, there was, new orders was down, inventories are up, so that's not great. And you can also see that employment was down. So you see here employment and new orders are sort of trending in the wrong direction here. This is not yet in panic stations, but the point is that if we continue to get this kind of weakening data, that would tend to confirm the fact that the Fed will cut on December the 10th. And of course, we had Powell yesterday giving a speech, no comments on monetary policy. And had he felt the need to sort of correct the market's sort of understanding that they will cut on December, that would have been the moment to have done it. But he didn't say anything. So we have to assume that we do have a 25 basis points cuts coming on December the 10th in about just over a week or so. But getting back to the ISM manufacturing, as I say, it is for September, but interesting to know what was happening before the shutdown. You can also see here that the inventories, which is this blue number, are actually going up, which is what you don't want. So we're starting to see here that an interesting spread a lot of people look at is actually the new orders, which is positive going forward. That's what you want. You want strong new orders going forward and lowering and lower sort of inventories. But the problem here is that the spread is actually sort of going down. So you see here the black one, new orders versus inventories, is actually going well below sort of 50. So overall, not a great report. It's sort of fairly soft. We have the ISM manufacturers price index, which is still at quite elevated level, so still above 50, but definitely coming down. So overall, what seems to be happening, I would say, is we have a job market which is just sort of stable at this point. And of course, we're going to get sort of initial jobless claims and the ADP numbers coming up over the next couple of days. And that will give us a bit of a read, sort of more timely information on the labor market. But at this point, it does look as though the labor market is, let's just call it sort of flat at this point. So not really collapsing, but certainly not accelerating. It looks like the real economy is okay. Certain parts of the consumer base are doing quite well. Certain others are not doing so well. So this famous sort of K-shaped analogy. And really the question is, at what point will the lower end of the K really collapse? That could be a function of the labor market. And if and when, or perhaps never, will the top part of the K actually sort of start attenuating their spending? So that's where we're at. And that seems to be that the Fed has said, hey, there is some anecdotal evidence from the Beige Book that, the economy is just stuck a little bit. And allied to that, you could have sort of political pressure starting to build, especially in 2026, where the Trump administration, who were probably a little bit spooked by the, relatively good performance of the Democrats in some of the elections we had in the last cycle, a month or so ago. We could get a situation where the Trump administration does start to turn its attention towards the all-important midterms coming up at the end of 26. And we could see, over 26, a whole sort of boosting of the economy or an attempt to boost the economy. So who knows, sort of maybe a more dovish Fed chair, some form of quantitative easing should come in, potentially boost to the sort of the crypto space, strategic, Bitcoin reserve. All of these kind of things could start to feed into, sort of an economy which, is due for some kind of boost. We shall see. So let's keep an eye on the data. Not a huge amount of data this week. In terms of the data, though, what we did get is this morning. Let's just turn our attention to a few other things. We did get this morning. Where is that going to be? We did get this morning the inflation numbers coming out of Europe. So if we look over at Europe, got those about 5 a.m., so 2.5 hours ago. So we see that inflation in Europe does seem to be relatively contained at this point, which will be good news for the ECB. Keep in mind as well that the ECB, they've cut down to about 2% their overnight rate. Keep in mind the Fed, they have an effective Fed funds rate at the moment, about 3.88. So, the differential now is about 2% in terms of the overnight rate. So at this point, the ECB seems to be in a good place. And you see here the inflation rate year over year flash for November. So a relatively sort of timely number. You can see here just above 2%, 2.1 to, actuals 2.2%. So that's pretty good. If you look at the core number, so that's the headline number. If you look at the core number, 2.4 again, which is, not too bad, certainly, closer to two than to three. And then if you look at the month-over-month number, you can see that it actually deaccelerated. So -3%, which was actually less than last time. So, relatively good news there for the ECB. They maybe they won't feel the need to sort of hike at any point. Does this justify another cut? Not exactly, unless the economy starts to really sort of deteriorate over in Europe, but that doesn't seem to be the case at the moment. So we are sort of getting this interesting point here where the ECB, the US does seem to be cutting and the ECB staying pat. Now, what's interesting, I want to look at some of the differentials here, which we haven't looked at for a little bit. So if you look at here at the US 2-year, subtract the German 2-year, you can see this has been, a whole sort of path over the last, couple of months or so of those differentials coming in. So you can see here that the US 2-year was 2.4% above, whereas now it's, as you can see here, it's now about 1.46. So ordinary, and that's normal because what we've seen here is that the US rates are slowly sort of going down and down and down, whereas the Europeans at this point, and approaching Europe. Now, the question really is the Fed is going to cut 25 basis points and potentially a little bit more under a more dovish Fed chair. It looks as though there's going to be an announcement about Kevin Hassett or maybe someone else, but some announcement from Trump before Christmas. Will that breach? It's going to be a very interesting level to look at the 2-year differentials here at about 1.4, let's call it 1.39, 1.4. So that's that one. And if we look at something like, let's say, the 10-year, a bit more of a benchmark, you can see as well that being pretty dramatic. So this is the US 10-year versus the German 10-year. And you can see that since the beginning of June, so let's call it about the last 6 months or so, we're almost at a 200 basis points advantage, so to speak, of the US. But that's really come down now only to about 1.34. So what's interesting is that ordinarily that would have led to potentially sort of a strengthening euro in this case. And if we look at the situation over in Japan, because everyone's been talking about Japan a lot, let's also look at the differential. And this is actually very, very interesting as well, because you can see here that going actually all the way back to 2023, it's been a bit choppy, but essentially the trend here, and again, April, May, June, has really been for those differentials to come in. So what we're seeing is that the rest of the world is starting to play a bit of catch up, and that's because of sort of more debt spending potentially in Germany. We're also seeing in Japan, obviously, the new Prime Minister Takeichi is quite keen to stimulate the economy. There's some sense that inflation in Japan is also not completely under control. So what we're starting to see is that the Japanese 10 and 30-year yields are going higher. We're also seeing that the German 10 and 30-year yields have been drifting higher. The French 10 and 30-year yields have been drifting higher. Also in the UK, we've seen that the 10 and 30-year yields have been drifting higher. So overall, there has been a drift higher at the back end. And in many cases, that's been on an incremental basis. It's been a little bit more than in the US. And so that's causing a lot of these differentials to come in. So ordinarily, that would have, according to sort of classical theory, would have led to US dollar weakness. And we have actually, in fairness, seen quite a lot of US dollar weakness sort of structurally. Again, if we look at the dollar index, you can see going back, 2025, the dollar has actually come down a lot. So that makes quite a lot of sense. A lot of those differentials have closed up. So the US yields have been yielding less comparatively to their developed market cousins. But just recently, we've seen the US dollar just have a little bit of strength. So the question now is, can the US dollar push higher? And, if the Japanese continue to stimulate their economy, continue to sort of issue a lot of bonds, potentially we could see that differential come in a little bit. So let's keep an eye on that. On the other, so again, just want to have a quick look there. I've just got a couple of charts here which we'll have a look at, just talking about Japan. Just sort of pulled these from Bloomberg this morning. So you can see here, just in terms of the carry trade, and a lot of people are saying the carry trade doesn't seem to be as prevalent if you look at the numbers from compared to, let's say, 15 or 20 years ago. But nonetheless, at the margin, it does seem that if yields in Japan are sort of rising, on a comparative basis towards the US. The incentive for sort of borrowing in yen and then reinvesting that maybe in US treasuries or other sort of assets outside of Japan, maybe that incentive diminishes somewhat. Because you can see that it has actually been a fairly sort of positive trade. Again, this is just sort of, sort of normalized down to the index of 100 going back to 2022. And as the headline's saying here, you can see that over the last few years, that's returned on average, over 12%. So that has been a pretty good trade. And that's been based on, a fairly stable Japanese yen, a weakening Japanese yen, which of course, and of course, an interest rate differential. So if you have the borrowing currency, the funding currency actually weakening, and you have an expanding differential, that's a great trade. And as you can see, it's paid over about 12% on average over the last years. But but the point is, if this starts to unwind a little bit, but in a more general sense, if we start to have Japanese yields going up and the U.S. Treasuries just remaining stable, that incrementally at the margin will make it. There could be some repatriation of sort of Japanese yen. And so the question is, are we now at a point where the Japanese yen has had enough weakness and the US dollar needs to come in a little bit? Let's bring this back here. So let's just look at that. So as I say, those differentials has caused, sort of US dollar weakness in general, but specifically, we've got a situation here, if we look at the yen, where there was a bit of a pop. Let's just look at where we're at on the daily chart here. But as you can see here, the yen didn't quite get up to that resistance at about 159. There's some sort of threat of intervention as well. But, the argument could be made that, the US dollar grinding high here. Is this some kind of bull flag? Are we going to retest a little bit higher? It's possible, because the other thing as well is that, over the weekend, there was a lot of concern. Ueda made his comments, Ueda from the governor of the Bank of Japan, of course, that maybe there could be some normalization on the way. So we did see some yen strength here. But as you can see here, just looking on this daily candle, that was fairly quickly reversed. And it's just turning into some kind of bull flag kind of situation here, where maybe the US JPY wants to give a run to this recent high of 157.9, or even up to this overhead resistance at 159, 158.9. At that point, the talk of intervention will come back in. But we have to keep in mind that last night there was a fairly strong auction for Japanese 10-year bonds. So maybe it's a little bit premature to say that, oh my God, the whole global market's blowing up about Japanese yields are going to explode. Okay, there was a way to comments, but he's always very cautious, and we have nothing specific at the moment. So let's keep an eye on USD JPY. We can also keep an eye on the euro. As I say, we just had the inflation numbers. They seem relatively benign, or at least benign enough not to cause the ECB worries. You can see here that, is this the euro bouncing against the US dollar? Maybe, or it could just be, this is a fairly well-defined trade range at this point, as you can see, with support around about the 115 level here. Now, if we get a Fed cut, which seems fairly obvious, it's fairly 90% priced in. If we get an announcement that the new Fed chair is indeed Kevin Bessent, he said that he's quite sort of dovish, quite expansionary, and obviously an acolyte of Trump. So could that cause a little bit of dollar weakness? Could we also get some weak, sort of continuing to get some weak survey numbers from ISM services later in the week? The core PCE is expected in the US to be benign, also like in Europe. So if we get a combination of weak data over the next 2 or 3 days, Bessent may be named as the new Fed chair for next year. Could that cause a little bit of a softening of the US dollar? Absolutely, over the next 3 or 4 days, and that could cause the euro dollar just to kind of grind its way higher, maybe up to the 117 level. That wouldn't be at all completely sort of unexpected. In terms of some other markets, guys, just keeping an eye here on oil. Some interesting stuff happening at oil. Today, for those of you who follow the politics of this, we have special envoy from the US, Steve Witkoff. He's actually meeting at the Kremlin with Putin today, talking about Ukraine. And of course, we know that, that's not going to be easy with Putin. He's not going to roll over and simply say, yes, fine, great. He wants some territorial gains. He also probably wants the sort of lifting of any sanctions. Nonetheless, let's keep an eye out for headlines. If there are sort of positive headlines, inching closer and closer to a potential ceasefire in Ukraine, we have to expect that, at the limit, there would be sort of more barrels coming onto the market, and that would be a negative for oil. There's also a lot of talk that, there's been huge pressure behind the scenes. A phone call apparently a week ago, some kind of negotiation, Maduro of Venezuela negotiating for an exit, to have sanctions lifted against him, sort of immunity legally, all of these kind of things. So who knows? There could be a headline at any minute that Maduro leaves Venezuela, goes into asylum somewhere, I don't know, maybe Cuba or Mexico, who knows? If that's the case, we have to assume that there would be a lot of interest in the Venezuelan. They have the largest sort of oil supplies in the world, or reserves in the world. Their production is absolutely cratered over the last 10 years or so. So we'd have to expect that, the market might interpret that as more, at some point, maybe more medium to longer term, but at some point more Venezuelan barrels coming to the market. Plus, if we have some kind of ceasefire or rumblings of a ceasefire in Ukraine, and who knows, maybe some kind of lessening of the restrictions on sort of Iranian oil, although let's be honest, the Iranian oil has been in the black market. But if you put all these factors together, allied to the political issue that Trump definitely wants lower gas prices politically in 2026 going into those midterm elections, we could see some further downside pressure, maybe at least in the medium term on oil. And as you can see here, oil, it's trying to sort of perk up because we know that the OPEC Plus they did decide not to increase their output for the first quarter of 2026. Okay, great. That did put a little bit of upward pressure on the oil price. But as you can see, that's pretty short-lived. And all things considered, that was relatively pathetic. And this is just trading, the minimum we can say is in a range. But if we put it here on some moving averages here, let's just open up EMAs. You can see here that it's still finding it very, very difficult here. I mean, it's barely been above the 50-day EMA, which is the second one here for the last sort of period. Like it's just trading very, very heavily. So oil under quite a lot of pressure. And as I say, any headlines about Maduro leaving or a ceasefire in Ukraine or getting closer to a ceasefire, I do believe those would be oil negative. Having said that, oil negative, that's a positive for the US inflationary picture. That would mean the Fed would be more confident about sort of cutting interest rates. That all things considered should be, that should bring down the yields because as we know, the US bond yields, they do prefer lower energy prices because that's less inflationary at the limit. So all of that would be a positive. And then just finally, if we have a look at the equities here, we can see that the VIX, always important to keep an eye on the VIX. The VIX is still about 1% per day, so it's at about between the 16 and 17 handle here. But as you can see, that spike we had a few days ago is getting relatively contained. Now we're not at the lowest VIX levels we've had of 14 or so, but for sure this is slowly coming down. Could this be a bit of a tailwind for equities? Absolutely, because vol targeting funds, they tend to degross or deleverage when you have a VIX or volatility spike. So we can assume that up here, there, and up here, there was some deleveraging of positioning, some taking off in positioning sizes from some of the vol control, and as that moved over a little bit, maybe some of the CTA. So the systematics maybe just deleveraged a little bit, but as volatility is going down, some of those vol control, vol targeting funds will sort of be edging back into the market. So, as we see up here, that all makes sense if you look at the price action on the S&P 500, for example. So let's keep an eye on that. But, you have to also say for the bigger picture, are there sort of, compelling reasons to be shorting at this point? Not necessarily. It's difficult to see some. We have, broadly in the White House and the administration, a very capitalistic, deregulatory sort of environment. We have to say that Trump doesn't want to see the market go down. Probably the new Fed chair doesn't want to see the market go down. And as we go into the election cycle in 2026, Trump will be cognizant of the fact that, he wants to stimulate the economy, which, all things, considered would probably be good for sort of equities, sort of broadly speaking. So, can we see this grind higher? Absolutely. Maybe to test the recent highs, 6,900, then maybe these all-time highs are 6,950. And who knows, at that point, we're going to start getting relatively close to the magnet of 7,000. So, can this grind higher? I think that's absolutely possible. And what we are seeing as well is a certain broadening out. If we look here just at a couple of metrics, I mean, not perfect, but interesting. If you look at the percentage of stocks in the S&P 500 above the, as you see here, above the 50-day average, you can see that that's actually had a little bit of a comeback. And if you look at the RSP ETF, which is for equal cap, equal weight, you can see that that's also had a nice comeback. And, all things considered, is actually trading quite well. I mean, just for context, let's look at this equal weight. Even before Trump had his Liberation Day sort of comments. So, they rebounded quite nicely and doing quite well. So it seems as though there is a sort of a broadening out of breadth in the market. So it's not only about the Mag 7s. And if we look at the Mags here, you can see, is that coming up? We'll just see if the Mags, they've come off a little bit, but, doing quite well. So it does seem that overall, SP 500, there is a broadening out, not only in the tech behemoths, but also in sort of broadly speaking. And, maybe just to finish off here, looking at the Russell, you can also see that the Russell itself has had a very strong sort of comeback. So the smaller caps and the equal weight are doing pretty well. And it looks as though the Russell maybe wants to test the highs as well. So all things considered, we can no longer just say that, oh, this is only driven by these large cap stocks. There's more participation happening in that. So potentially what we could see here, if the economic data weakens just enough not to scare the market, but enough to justify Fed cuts, we could see sort of yields stabilizing at the front end, maybe even coming down a little bit. And that would be a green light for equities, maybe just to grind up into sort of a modest Santa rally over the next 2 or 3 weeks. Okay, guys, I'm going to leave it there today. Have a great trading session, and I'll be back tomorrow with the macro snapshot. Thank you.